to the cloud. Got it. And show from current slide. Okay. Now, what we've been talking about up until now has really been service organizations, right? Many of the questions you even saw in the exam, we're talking about a service fee, service revenue. We mow somebody's backyard, they pay us to do that work. We clean up their backyard, they pay us. We cut their hair, they pay us, whatever, okay? Now what we're going to move into is, well, what happens if we're a business that is, and here they're calling it a merchandising business. Another term probably more commonly used is a retail entity. If I'm a retail business, then what I do is I buy inventory from somebody else, and then I sell it to you, my customer, at a profit. So the one that I like to use is Nordstrom. Okay, I like to walk around Nordstrom sometimes. I don't buy much from there because I think they're too expensive, but whatever. I go in there into Nordstrom and I see a shirt I like. I see a pair of pants I like, whatever, a pair of shoes I like. Let's go with shoes. I see a pair of shoes that I like. And I say, okay, I want to buy these. Now, let me ask you a question. Did Nordstrom make those shoes?
No, they didn't.
No.
Generally, no. What happens? They acquired those shoes from somebody else. They put them up there for you to come and try on and decide whether or not you want to buy them, et cetera. And let's just forget about online shopping here for a second. Okay. So in that instance, then what? Nordstrom is the retailer. They are selling you the shoes. They're going to list whatever they sold those to you for on their income statement, sold them to you for $100. But of course, Nordstrom had to pay, I don't know, Christian Louboutin or whoever it is that they got those shoes from. So they would maybe have a cost of course, you wouldn't get a pair of Christian Louboutin for $100, but humor me here. Okay, $1,000. But they had to pay what? They had to pay $800 for those shoes. So they would have what? On their income statement, they would show revenue for that sale of $1,000 or sales of $1,000. They would show cost of goods sold of 800, and then they would show a gross profit of 200 in that particular example. So that means we're going to have to understand a couple of new things here. One, how does the structure of our income statement get affected now when we are a retail entity? And we're going to have to understand how to account for the purchase of the inventory and how to account for the sale of that inventory. That's the major takeaway from our discussion today for chapter 6 here. Okay. All right. So you go ahead and let's first talk about the structure of the income statement. And with the structure of the income statement, we'll show our sales. Okay. Sales, revenue, synonymous. Sometimes you'll see it called revenue. Sometimes you'll see it called sales. In a retail entity, though, it's typically called sales. Really? So anyway. There it goes. Okay. In a retail entity, it is typically called sales. Okay. Then we have the cost of goods sold. So if we were preparing Nordstrom's income statement in that little example I just gave you, we would show sales of 1,000. We'd show cost of goods sold of 800, and we would show a gross profit of 200. Now, what happens? Gross profit, okay? I can't emphasize enough how important a number like gross profit being displayed on a company's financial statements is. The reason it is important is that analysts will look at that gross profit number and they're interested to see, well, what does this company have left to cover its day-to-day operating expenses? You need some fat there. Think about this. People want a fat gross profit. Nobody sits here and says, hey, gross profit, you might want to mix in a salad or go jogging or something. Gross profit, we want it to be nice and fat. Why? We're sitting there and we need that to cover our operating expenses. Nordstrom really doesn't have a whole lot of control over whatever Christian Louboutin or whoever the maker brand of those shoes are. They got to pay whatever they're charging companies to purchase that inventory from them. So they're kind of stuck with that cost of goods sold. This they can control. Not the gross profit, but the operating expenses they can control, excuse me. This they can control right here. They can control that. For example, do we really need to have 10 salespeople standing around, or can we deal with 5 salespeople standing around? Do we really need 3 vice presidents, or can we go with 2 vice presidents? Do we really need to have a 3-story building, or can we move to a smaller facility with lower rent costs? Do we really need to have a piano player there to entice people to buy, or can we eliminate that expense? Okay, so there's less control over the cost of goods sold, but there is some control over the operating expenses. But the more gross profit we have, the less susceptible we are to having our net income being affected by operating expenses. So analysts are very interested in that gross profit number. So we have sales less cost of goods sold equals gross profit minus our operating expenses. There's that word expenses, gives us what? Net income. So let me ask you a question. Is cost of goods sold more like our revenue or more like our expenses in terms of how it affects net income?
Expenses.
Good. It's more like expenses. Obviously, you can see that the less here, we subtract our cost of goods sold from our sales to get our gross profit, and then we subtract whatever's left from our operating expenses. That gives us then the net income. So cost of goods sold reduces our net income. So you're saying, well, John, if we're subtracting like an expense, why don't we call it expense? It's a nerdy accounting thing. It's a nerdy accounting thing. We're simply sitting here saying that it's not really an expense because the future economic benefit has not expired. We're passing that future economic benefit on to our customer, but it still reduces our net income because we had to incur that cost in order to be able to generate that net income, that sale, and eventually that net income. So cost of goods sold is like an expense, but we don't call it expense. We call it cost of goods sold. Okay. Now, let me ask you this. If cost of goods sold is like an expense, how do I increase it?
Debit it.
Good. Excellent. Nice. That's how I want you to answer questions in this class. When I say increase, decrease, we talk in terms of debits, credits. Beautiful. So I'm going to have to debit cost of goods sold when I sell something. And I'll talk to you about the rest of the journal entry for the sale here in a second. Okay. Question. Okay, good. So let's go ahead then, if there's no question on that, and let's talk about a couple of cost flow assumptions. One is called perpetual, you can see on this slide. The other is called periodic. Now, with the perpetual inventory system, each time we purchase inventory, we will make a journal entry in our accounting system for the purchase of that inventory. Do you think inventory is an asset?
Yes. Yeah.
Inventory is an asset because it has the future economic benefit that we can sell it for a profit. That's quite a benefit. So if we bought inventory, and let's just keep with that little Nordstrom example, and they bought the Christian Louboutin shoes for $800, we would debit inventory. We would credit, and I'm assuming that they're going to pay Louboutin a little bit later, so we would credit accounts payable. We have that liability of $800. Now, if we're sitting here, we have our inventory account. 800. I always write it too far over. So I'll just put it at the bottom. We have our inventory account here. And let's say, just for discussion's sake, instead of that being one pair of shoes, it's two pairs of shoes. They got two pairs of shoes. Each pair of shoes cost Nordstrom $400, let's say. So they have inventory of 800. And of course, they have this bill, accounts payable. I'm not going to tee that up. Okay. Now, a little bit later, Nordstrom turns around and they sell one pair of those shoes. Okay. What do you think the journal entry will be for the sale of one of the two pairs of shoes? Each one costs Nordstrom $400, and Nordstrom charges their customer $1,000 for those shoes. What do you think the journal entry will be?
Credit inventory.
Good. I'm going to credit inventory for 400. Beautiful, because
You only sold one pair of shoes.
I sold the one pair of shoes and now I'm just left with the one, right? So I would go ahead and credit inventory. Sold one, I still have one. Good. What do you want me to debit?
Cost of goods sold.
Good. Debit cost of goods sold. In this class, you'll get used to me abbreviating cost of goods sold, guys. That's COGS. Okay. So I would go ahead and debit my cost of goods sold for 400. Okay. COGS, cost of goods sold. Good. Anything else I have to do? Say it was a cash sale.
Do you have to credit your cash?
Not on this planet.
Oh, wait. No, debit your cash.
Oh.
Just a second, guys. Brother, yeah. I guess I could do it that way. Now they make me make a decision. Do I want to discard it or keep it? Guys, make sure you're muted, unless you're going to be contributing to the class. Okay. Okay, good. So I would go ahead and I have to start this stupid thing over. I'd go ahead and when I buy the inventory for 800 for the two pairs, I credit accounts payable for 800. I go ahead, I have my inventory account down here. Debited 800. Balance is 800, right? And then I don't know who was speaking, but when we sold the inventory, we sold one pair. We debited cost of goods sold 400, and we credited the inventory, right? Because we're now down to the one pair that cost Nordstrom, in this example, 400. So that's showing that we got one pair left that cost us 400. And of course, we had the sale. It was a cash sale. What do you want? What's the journal entry you want me to make? I think it was Elizabeth.
Would you debit your cash?
Yeah, I'm going to go ahead and I'm going to debit cash for what I sell it for. I said 1,000.
1,000, yeah.
Okay. What do you want me to credit?
Inventory.
I already credited inventory.
Merchandise.
When you sell somebody something, have you earned anything?
Yeah.
Yes.
When I earn something, what account should I credit?
Oh, revenue.
Revenue, good. But now we call it sales. Revenue, sales, guys, kind of synonymous terms. Don't get hung up on that. Okay. So we would credit sales because we sold the thing, right? Now, when we prepare our income statement, we would show sales. $1,000. We'd show cost. Gee, I'm assuming we would show cost of goods sold, right? As we prepare our financial statement of, what was it, 400? Right? Picking that up. What's my gross profit?
1,400.
Not on this planet.
Oh,
Try again.
600.
600.
600, we have the $1,000 sales, we have the cost, and we're left with a profit, right? Profit is what's left over, gross profit, before we start dealing with our expenses, our operating expenses of $600, right? Question. Okay, good. So that's where we're going now. And what I've just described to you was the perpetual system, was the point of this slide, in which every time we purchase inventory, every time we sell inventory, we will make an entry into our inventory account so that at any point in time, Nordstrom should know what the cost of the items are that are sitting in their inventory account, right? First, we knew we had 800, then we knew we had what? Then we knew we had the 400 that was left. That's called the perpetual system. Question. The perpetual system is what we will focus on in this class. It's what I'm going to ask you about when we take our second midterm. I'm not going to ask you about the periodic method, but I think it is important that you at least have some sense of what this periodic method is about. Periodic method is becoming somewhat obsolete, and that with the advent of the scanning capability of computers, companies can automatically update their inventory each time they have a purchase and a sale. So when they purchase something, there's probably some barcode on there from whoever they acquired that from. They scan it, and it automatically goes into their system that they have acquired that inventory. The inventory balance goes up. When they sell it, when you go to Nordstrom and you buy something and they scan it, and you're thinking, okay, they're scanning it just because they have to hand me a receipt and tell me how much this is going to cost. At the same time, what's happening is their inventory records being updated. So because of the capability of scanning everything, most companies, I'd say probably in the high 90s these days, will use a perpetual system. Now, in the old days, you would have had to have done what? Somehow manually updated your inventory record each time you acquired inventory. You'd have to sit there, and each time you had a sale, you'd have to go and update your inventory accounts. And companies didn't want to do that because that was too time consuming. So they used something called a periodic system. So under a periodic system, what you would do is when you purchase inventory, instead of sitting there and debiting inventory and then burdening yourself with the thing that you were going to have to credit inventory when you sold the thing, okay, probably the more difficult piece of it, what they would do is they would debit an account called purchases. In that example for 800, and they would credit accounts payable cash, however they paid for that, however they plan to pay for that. Now, at this point, the purchases account would sit there. And then what they would do is when they sell the thing, they would debit cash. And we're assuming it was a cash sale. Could be a debit to accounts receivable. And they would credit the sale for $1,000. And that's all they do. They wouldn't update the inventory account the way we did here when we had the sale, because they were under the periodic system in those days, and they didn't want to have to go and make an entry into their inventory account each time they had a sale. So what would happen? They would sit there and they would wait till the end of the year to count the inventory. Okay. And then at the end of the year, they would count the inventory to see how much was left. Okay. So let's just use this little calculation down here is how you figure out the cost of goods sold. Let's say, not very realistic for Nordstrom, but let's say the beginning balance for this company's inventory was 0. They purchased 800. So what were their purchases? If I purchased 800, what should I put as purchases that I'm going to add? I'll wait because I'm not going to ask you an easier question today.
You add 800.
Okay, I show purchases of 800. I mean, when I ask something like that and I don't get an answer, I assume you fell asleep, so I'm just going to wait for you to wake up. Okay, good. The beginning balance, add the purchases. So what's the goods available for sale?
800.
800, good. And then Nordstrom would come along and count their inventory. This company would come along and count their inventory. And when they count their inventory, they'd see they have what? One pair of shoes left that cost them how much?
400.
That cost them 400. So they would go ahead and they would subtract whatever was left at that point. And their cost of goods sold would then be what?
400.
$400. But they'd have to wait till the end of the year to calculate that, because they would sit there and say, okay, well, I see we still have, $400 worth of items in inventory. So our cost of goods sold is 400. Now, then what they would do at the end of the year, because they do have to report their inventory, they would debit inventory for how much is left?
400.
400.
400. They would debit, how much is my cost of goods sold?
400.
400. And they would close that purchases account. They don't need it anymore. They don't need a purchases account anymore, right? Because when they purchase the inventory, they would have debited purchases for 800, but they don't need it anymore. It achieved the objective. When they went ahead and they had to show what their purchases were, they were able to figure that out to help them calculate, not show it because they don't report that anywhere, but they would say, okay, here's what my purchases were. I can calculate my cost of goods sold. And so at the end of the year, you just close that. That would be that credit. Okay. Now, let's say Nordstrom went through the whole year, and when they got around to counting the inventory, there were no shoes out there. So what would that mean the ending inventory was? Not a trick question.
0.
0. And the cost of goods sold then would obviously be what?
800.
But they'd look around and say, wait a minute, we didn't sell the second pair of shoes. We didn't sell that second pair of shoes. There's no sale for that. Why aren't there shoes there?
Because someone stole it.
Because maybe somebody stole them. So, under the periodic method, they should probably call this the cost of goods sold and stole. Okay. So you can sense here, there's a weakness here. We'll talk more about internal control later, but there's a weakness here in their internal control, and that they're waiting to the end of the year to discover what? Theft. Well, that's not good. Okay. That's the reason. That's, the technology advancement probably has more to do with it, because companies lived with this for years before the scanners came in and stuff. And once that came, then people said, beautiful, we're going to use the perpetual system, because with the perpetual system, I'm updating my inventory records after each sale. And, just let's use the obvious. If my inventory balance, which I would look at any point in time that tells me what I've got in inventory, says 400, and I look out there and there's no shoes, I know before the end of the year that something's happening, my stuff's being stolen. So I need to start doing things like, it's getting bad, right? I mean, I walk into CVS, there's a dude with a Glock sitting there. I'm like, holy Toledo, really? You're gonna shoot me if I accidentally take an extra can of shaving cream? Okay, but this is how it is now, or they have a guard there, or put up, security cams. We'll start doing some things that will help to mitigate some of that problem. And we would realize that we have that problem because we're using this perpetual system. Okay. All right, so just a little bit of, understanding of the difference between periodic and perpetual. I'm going to be asking you perpetual. We're going to be going through an example right now in the slides. They're going to walk us through an entity buying inventory, accounting for the payment of the accounts payable on that inventory, selling that inventory, recognizing the cost of that inventory, etc., and then how that's going to be displayed on our income statement. That's really where we're focusing. Before I get to that, as part of getting into that, does Nordstrom take stuff back if you decide you don't want it?
Yes.
Oh yeah, that's the reason they charge you a little extra, because you could probably wear a pair of shoes for about a week and then come back and tell them, well, they're pinching my foot, I don't want them. And one of their operating expenses is they train their people to take those shoes back like this. Oh, you don't want the shoes? Oh, that's not a problem. Okay, even though deep down inside they're thinking, look at these nasty shoes. What have you been doing with them? Okay, so what happens? We're going to have to understand something about returns as well. Okay. The other thing we're going to look at is what happens if we are offered a discount for paying on our account payable when we acquire our inventory. How will we account for that? And what if we offer a discount to our customers on a sale? Okay, so that's where we're going. We're going to look through a transaction using the perpetual system, an example of a set of transactions through perpetual system. And we're going to add on to the little bit of discussion we've had so far, sales returns, sales discounts, and then we're going to talk a little bit about how our income statement is going to look when we're a retail entity as opposed to a service entity. Okay, all right, so let's go ahead and let's take a look at this example. And we've got this company that is purchasing the inventory. We're studying the perpetual system. They purchase inventory for, I don't know, $3,800. I guess they could have put that in the fact pattern. We purchased it for $3,800. What's the journal entry? What do you think? Perpetual system to purchase inventory. And they're going to purchase it on account, even though it doesn't say that here.
Would you debit inventory, credit accounts payable?
Beautiful. Debit inventory, credit account payable. Nice. There we go. Okay. Now, what I'm going to do, guys, if we were in class together, I would have the whiteboard and I'd go over and I'd write the inventory account on the board, but I'm just going to do it right here. Okay. And so we debited inventory for 3,800. I'm trying to think the best way to do this. Is that this way? Okay, let's see if it'll let me write on it. Now I can go back into slideshow mode. Okay, good. So I'm going to just tee up the inventory here. God, my phone is annoying. I'm sorry that it keeps buzzing while we're trying to, how much was it? 3,800? Well, while we're trying to do this, you know, my phone will sit silent all day and all night. Sometimes I think maybe I died and that's my punishment, that my, you know, nobody can reach out to me anymore. And then as soon as I get in class, the phone starts buzzing and ringing. So I apologize for that. Okay, 3,800, and then I'm going to do what? I'm going to credit my accounts payable for 3,800. And the balance is 3,800. Okay, good. All right, now I will go ahead. I made that debit to my inventory. I credit accounts payable, and you saw me post that. Any questions so far? So I've got some inventory, and we're going to get around to selling this at some point. Okay. Actually, what we're going to do is we're going to see how the seller would account for this same set of transactions. So right now, we're looking at the buyer and at the purchaser of the inventory. In a little while, we're going to look at the seller side of this same transaction. Okay. Now you come over, and we now have this issue of transportation costs. Okay, the freight, sometimes they call that freight. Now these two panels on this slide are mutually exclusive. It's either one or the other. It's either one or the other. Okay, so up here we're dealing with the purchaser. Okay, this is the purchaser. That's the purchaser. So if the purchaser pays, then we're going to go ahead and we're going to debit our inventory account and credit cash when we pay the deliverer, we pay Lyft or whatever. Just think of it that way. When you pay Lyft, you pay them in cash. They don't say, okay, we'll bill you and we'll get back to you. You pay them up front, right? Okay, so we're going to credit the cash and we're going to debit our inventory account. Now we debit our inventory account because the rule is that any money you spend to get an asset to your business so you can use it productively in your business is part of the cost of that asset. Anything that you pay to get an asset to your business so you can use it is part of the cost of that asset. So obviously what? The invoice price, you had to pay that. Okay. The freight charge, I don't have those shoes at my warehouse or the stereo equipment, in this example, whatever it is, at my house, at my business. I don't have it at my business. If I don't have it there, then how am I going to sell it to you? So part of the benefit for me of having that there is that you'll walk in, you'll see those shoes, you'll try them on, you'll like them, and you'll take them, right? And so what happens? We make that part of the cost of that asset. What if you're buying a computer? And when you buy a computer, you walk into the computer store and you pick the one you want, whatever, and then they always charge you that environmental disposal fee or whatever it is. Do you have to pay that tax, whatever they call that, that fee, in order to take the computer to your business so you can use it?
Yes.
Go ahead. Try and not pay it. Tell the person, I'm not paying that, and try to walk out with the computer, see what happens. So you have to what? You have to incur that cost in order to get that computer. That would be part of the cost of that piece of equipment, let's say, that you're using in your business. So let me repeat the rule. Any cost that you have, any money, whatever that you pay, in order to get an asset to your business so you can use it productively in your business, is part of the cost of that asset. Question. Okay, good. So now I need to go back and I'm going to add that that 150 to my inventory. And guys, I'm not going to track the balance here. Let's get used to using a T account. I don't want to track the balance for this because It's too much trouble. Okay. Okay, good. So now I've got that cost added to my inventory. Now, these are mutually exclusive. What if the seller pays the freight? So sometimes you have to pay the delivery charge if you're the purchaser. Sometimes the seller will pay it. Have you ever encountered anything like that where the seller pays the delivery charge? That's a question.
Yes.
What was it, Elizabeth? Since you seem to be the only one that's interested in contributing today.
Well, I work for a logistics company and our customers pays the freight.
Okay, well, if the customer pays the freight, then you'd be up here.
Oh, really? Oh,
Yeah, this is the customer paying.
oh, okay.
This is the purchaser. This is,
Oh, okay. I see what, okay.
have you ever been in a situation where where the seller pays the freight? You don't have to have been the seller. You go, okay, let me just give you the example. You go to the store and you're at the furniture store and you're trying to, you know, lift up this heavy desk. And you could sit there and you say, oh, I'd really like this, but man, this thing, I don't know how the hell I'm going to get this upstairs to my apartment. And you tell the seller, gee, I really like this, this piece of furniture, you know, this desk, whatever, but I just don't think I can get it home. I don't think I'm going to buy it. The seller, little light goes on. The seller says, we'll deliver that for you. Now, why are they doing that? Why are they offering to deliver it for no charge?
Because they want you to buy it.
Because they want you to buy it. In other words, they're incurring a selling expense. Just like they have to pay the person the commission to sell that thing. Just like they have to pay the beautiful lighting that they have on that thing. Just like they have to pay to pipe in music, whatever. Just like they have to pay to keep the place clean so you feel like the furniture isn't dirty. All of these things, right? So it looks nice and clean. You want to buy it. You're looking at cars, right? You look at a car on the showroom floor, it's so shiny and everything. Well, they had to pay somebody to keep it shiny. And the reason they're doing that is they want it to look so beautiful that you lose your breath when you look at this car and you go ahead and pay whatever they want for it, okay? So what happens? That's a selling expense. And when the seller pays, and this example is mutually exclusive, you're either the purchaser or you're the seller. If the purchaser pays, we do what we saw at the top. If you're the seller and you pay the freight, then you debit an account called freight out, or it could be called delivery expense, but it is an expense. It is a cost of doing the business. Once you have delivered that and you have sold that piece of furniture, there is no more future economic benefit to that $150 you had to hand the driver. Where will delivery expense show up on our financial statements? Where will freight out show in our financial statements?
Income statement?
Yeah, well, it says expense. It's an expense, and it's going to show what? As one of our operating expenses. Question. You're one or the other. You're either the seller or the buyer. These are mutually exclusive, right? Okay. Okay, good. Now we're going to go forward with, in this example here, that you know, the purchaser of the inventory paid. Okay, but we wanted to show you that as well, if the seller pays. Now you come over, and what happens if there's a return? We're going to focus on return. Okay. Now, if there is a return, what'll happen? If there's a return, we're going to debit accounts payable and credit the inventory. Think about that. If you return inventory, do you have it anymore?
No.
No, you don't.
No. So we have to credit inventory. Let's talk about that credit first. And I think I'm going to go ahead and just rewrite my T account here, so I don't have to go back as far. So we debited it for 3,800. Then we credited it, then we debited it for 150, right?
Yes.
And the accounts payable so far coming into this slide, we had just credited for the 3,800, right? Okay, good. If you get rid of inventory, you don't have it anymore, so you credit it, don't you? To show that I sent that back? Right?
Yes.
I don't have 3,800 worth. I got 35, and then I have to have my shipping charges. And I debit the account payable. If you return something to the vendor, do you have to pay them for it anymore? Typically not, unless you like messed it up or something, but assuming, you know, you return it to them in good shape, they'll go ahead and they will take that out of your account, right? So now we only owe 3,500.
Yes.
Okay. Okay, good. Then what happens? Then we go ahead and we are going to receive a discount if we pay early. Typically, vendors want you to pay them in 30 days, sometimes maybe 45 days. But often a vendor will say, if you pay me early, I'll give you a discount. Okay, so the way you read this, and we call that credit terms, the way you read that is 210 net 30, which is saying I'll give a, this is your creditor saying, I'll give you a 2% discount if you pay me in 10 days. Otherwise, you got to pay me the whole amount in 30 days. So in our little example, the vendor is saying, hey, pay me this 3,500 in 10 days. I'll give you 2% discount. Otherwise, give me the whole thing, the whole 3,500 in 30 days. Okay, so let's practice with reading this a little bit. Okay, let's practice with this nomenclature to express discounts. What if it said this? I don't need to erase the other ones. What if it said, what if you got credit terms that said this? What would that mean? That's a warning.
1% in 15 days, or pay everything in full in 45 days?
Good. Excellent. Someone's on fire today. Beautiful. And I'm happy. I'm not trying to discourage you. Good. Excellent. Question. Now, sometimes I get students, non-accountants, that sit there and say, oh, God, this is so, what a waste of time. Let me tell you something. When you're in business, this sometimes becomes everything. The credit terms, you go through all this trouble to negotiate a price for a contract and whatnot, and then people sometimes forget about the credit terms. What are going to be the credit terms? And the whole deal falls apart because they haven't thought through how are we going to negotiate the credit terms. Think about it. If we're talking about what, you know, hundreds of millions of dollars of sales, whether it's 1%, whether it's 10 days, 15 days, 45 days, 30 days makes a big deal, right? Time value of money, which you'll get to more in another class. Why would a creditor even offer a discount? I mean, what's in it for them? Why are they doing this? Offering a 2% discount, you pay them in 10 days.
To get their money faster?
They want their money sooner. Excellent. Yeah. Okay. Okay, good. So let's say that we go ahead and, guys, don't worry about this is pretty much how everybody calls out credit terms. Don't worry about those other ones. Okay, we practice with that. Okay, now we come over and we're going to go ahead and we're going to take the discount. So when we take the discount now, we go ahead and we calculate the discount, 2% of the 3,500, 38 minus the 3 that was returned. That's a $70 discount. Okay, so if we owed 35, but we get a $70 discount, then we're going to credit cash for $34.30, aren't we? All right, we don't have to send the full 3,500. The guy gave us a discount. Now that bill is completely paid off because the guy had given us terms that if you give me what? $3,430 because he's offering me a 2% discount, I'll say you're good and you don't have to send me any more money. So we go ahead and we can debit the account payable now for the full 3,500. Is that zero now? Is that showing zero?
Yes,
Everybody? So make sure we're all still alive.
Yeah.
Yeah.
Yes.
Okay, good. So we don't owe them any more money. Okay, good. Thanks, guys. Okay, so we don't owe any more money. So we're sitting here and we have paid that account payable. We debited that. We credit the inventory for 70. Okay, now when we credit the inventory for 70, I think I can go, no, not yet. Yeah, I'll come back to this slide. When we credit the inventory for 70, guys, and this is just that same T account that I was working on with the inventory. Notice that what? It says that the balance of that stuff is 3,580. Now, how would you look at that? How much cash did we actually pay them? We paid cash out of, for this inventory, we paid cash out of what? 3430. Okay, let's see if we can recreate that number just looking at the way the transactions went with the inventory. We originally had a bill for what? 3,800, but we returned how much?
300.
300,
Yeah, well, we had shipping charges of how much?
150.
250.
150 that we added, good. And then we returned what, 300?
Yes.
Mhm.
Okay, and then we had a $70 discount.
Yes.
Okay, so the total cash that we paid out was how much? Somebody help me with that. 38 plus 150 minus 300 minus 70. $38 plus 150 minus 300 minus 70 is how much?
3,580.
3,580. And by the way, you could have looked just at the T account, understanding that debits increase, credits decrease, but good. My point being that when you think about it, of how much cash did I spend? I spent not the full 38 because I'm going to return 300, but I did spend 150 on the freight, and then I didn't have to pay the full 3,500 because I got a $70 discount. So the inventory account ultimately shows what? How much did it cost me to acquire this inventory? Isn't accounting beautiful? Okay. Now, coming back to this slide I went past, if you don't take the discount, then you just have to debit the accounts payable for 3,500, credit the cash. Okay, and now this company has their inventory account ready to go, and they can start selling the inventory, etc. And we're going to look at the same transaction from the seller standpoint here in a couple seconds. But with that, let me ask, is there any question about the purchaser's transactions for the inventory? Okay, good. I'm thinking, why don't we take a quick little break, okay? So we'll come back here at 10:45. And I think what our goal is going to be is to go through and look at the same set of transactions now from the seller standpoint. We looked at them from the purchaser standpoint. We'll look at them from the seller standpoint. And then we'll adjourn and we will get into the practice midterm and stuff on Tuesday. Okay. Okay, guys, let's go ahead and take about 10 minutes. We'll come back at, I'm saying 10:45, okay? Any questions so far? Okay, good. So what I want to do is I want to now jump us to now the looking at the seller's side. So the seller sold this inventory to the purchaser, and we've already seen the purchaser's accounting for $3,800. So when they sell it and they're offering credit, so they're saying, hey, pay me in 30 days, whatever, and we'll offer 2% discount, etc. And so when they first sell it, though, they go ahead and they debit the accounts receivable for $3,800. They credit the sales revenue, synonymous sales revenue, synonymous terms for $3,800, right? Now, since they're using the perpetual inventory system, they now have to account for the sale. And it's telling us that this stuff cost $2,400, okay? So when they go ahead and they record the cost of goods sold, what should they debit?
Cost of goods
Two
sold,
$1,000.
Good, we got to debit the cost of goods sold. What do you want to credit?
inventory,
Inventory for 2,400 because we sold that inventory. It's not here anymore. Good, excellent. Okay, all right, good. Then we come in and they say that there was a return of $300. And guys, let me put in the return journal entry here because somehow it got lost. I don't know where it is, but if they returned 300, okay, then do they still expect to receive 300? I'm looking at my accounts, I mean, 3,800. I look at my accounts receivable. And on the previous slide, I just debited it for 38. But then the person that you sold it to returned it to you. It can happen, right? My God. 3,800. What did 8 say? What did 0 say to 8? What did 0 say to 8? Nice belt. Okay. All right. So anyway, you'll probably get that joke later on today. Okay. So what happens? We debited 3,800, that says, okay. If somebody returns stuff to you, do you still expect to receive money from them for that stuff? Somebody bought $3,800 worth of stuff from you, and then they returned 300. Do you still expect the full 3,800?
No, you
No.
don't.
No, you don't. So you're going to do what? You're going to credit the accounts receivable for 300. What should I debit? And the account that you should debit, guys, and this is something new, is called sales returns. Now, I know that, you know, your instinct was, well, debit sales, John, but the company wants to keep track of their returns, don't they? Why would a company want to keep track of their returns? Why does a company care if customers are returning their goods?
they want to keep track of it for the end of the year so they can show their profit and loss statement.
Okay, well, it is part of calculating the financial statement, but Elizabeth, if I wanted to, I could have just debited sales. And my sales would show now 3,500. I credited sales here for 38. If I credited it for 38, that's my sales. And I debit it for 3, isn't the sales showing 3,500? I could prepare an income statement. But I would lose track as to what was actually returned there, right?
Right.
Okay, so why would I want to keep track of my returns? Why would I?
To see what products are being returned more often than others.
It has an operating aspect to it. Yes, excellent. That's exactly what I'm looking for. Hey, I want to know. Well, you know, maybe I've got a really great marketing campaign but I'm using cheap materials in my product. And when people get the stuff home or whatever, it gets delivered to them, they're like, this is crap. I don't want this. And they send it back. Okay. Okay, good. So we want to keep track of our returns. So in accounting, remember, we're accounting for business. From a business standpoint, you can set up an account for anything that you think is what is important for you to keep track of for your business purposes. Okay. So we don't debit directly to sales, we debit sales return. Okay, and our sales, of course, is still showing what? Our sales, just teeing that up from the previous slide, is still showing 3,800, right? Okay, okay, good. Now what happens? Now they tell us they're going to pay the 3,500 and they're going to take advantage of now it's our customer is taking advantage of our discount. So what happens? We go ahead, we credit the account receivable for the 3,500. Is it zeroed out now?
Yes.
That's zeroed out. Good. We debit the cash because they're only going to send us the 3,430, and we debit another account. We don't debit it straight to sales. We debit what? An account called sales discount. And we debit that for $70. Now we could have debited straight to sales. Look, guys, if we had debited the returns and debited straight to sales, then our sales would reflect the cash we actually collected on this thing, wouldn't it? 38, what's 38 minus 3 minus 70? 3,800 minus 300 minus 70.
3430.
3,430. So if we had put those debits straight into sales, the sales would show the cash we collected, but we would lose visibility as to what our returns were. We would lose visibility as to what our discounts. Why do we want to track whether people take our discount or not?
To see how much discounts you're actually paying out.
Well, we're not paying out a discount.
I mean,
what we're giving is a discount.
Yeah.
Okay. Why do we care? What if nobody takes our discount? What does that tell you about your discount? Nobody ever takes it.
That's not a good enough discount for people to want to take it.
It must not be very good, and maybe we should go ahead and sweeten that up a little bit, right?
Yeah.
order to motivate people to take. What if everybody takes it every time? Maybe we can squeeze that discount a little bit and find that nice little sweet spot where we're getting the benefit that we're looking for the discount without giving away, too much in the discount, right? Okay. Okay, good. So again, in accounting, remember we're talking about accounting for run our business properly. You can set up an account for anything you think is important and keep track of. Okay. Now, when you take a look at the next slide, you can see that our net sales, okay, this is an important term, net sales. Net sales are our sales minus our returns minus our discounts, give us our net sales. Okay. Now, often in and we call those contra sales, contra revenue accounts. Often when you pick up a set of financial statements of a company, what you'll see, they'll just show at the top of their income statement net sales. In textbooks, you always see sales minus discounts minus returns, because we're essentially, trying to teach you on that, showing you the income statement that way. But in practice, most companies will just start you with net sales. And then when you get to the footnotes of the financial statements, there'll be a footnote called Summary of Significant Accounting Policies. And in there, they'll tell you, hey, we have our net sales and we have backed out any cash discounts, any returns from that number. Question: Okay, so now from the seller's standpoint, just to quickly think about what the income statement would look like. Did they have any sales? Did this company have any sales? Woo-hoo, woo-hoo. Did this company have any sales?
Yes.
You look to the T accounts to see, you look to the ledger accounts to see what's in there. Sales. 3,800. Good. Did they have any cost of goods sold? Actually, this is
Yeah, they had $2,400.
2,400. Okay, it's not quite right. Yeah. Just put the cost of, there's a little problem there. Oh, we had sales and then we had what? Let me do it that way. We had returns. What were the returns?
300.
300. What were the discounts?
70.
70. Good, so the net sales are 3,430. And then we would have cost of goods sold. And that difference would be the gross profit. Right? Guys?
Yes.
Yeah.
Effect of these transactions, okay? Okay, good. Here I show you closing entries. Remember, to close the revenue, you debit it. To close the expenses, you credit them. That then what? That difference, which is the net income, this is not related to the transactions, guys. That net income that we've been looking at, that net income goes to what? Goes to income summary. Then we close income summary by crediting retained earnings. And if you pay dividend, then you close a dividend account. Okay. We already talked about the closing entries here. The key thing that in our previous chapters, the key thing here is to note that cost of goods sold is like an expense. So it gets closed along with the expenses, right? But we don't call it expense. We call it cost of goods sold. But notice it's getting returned along, it's getting closed, I should say, along with the expenses. Okay. Question. All right, guys, I am going to stop there, I think. I think that's enough for today. What we will do is we will finish the slides for chapter 6. There's a few more left next time, and then we're going to get into the practice midterm for chapter 6. Questions? Okay, guys, I will see you on Tuesday. Keep up the good work. Oh, before we go, if you, and I don't know that anybody did this. If you found something on the internet that looked a lot like the exam that I gave you, and you were thrilled when you found that thing, and then you went and you looked at the questions in the exam and you saw some questions that were the same questions, and you got excited and you put in the answers and you got 100% on the exam and stuff, and you're thinking now that you have a strategy as to how to not invest time in studying this material and get a good grade on the exam, think again, because that's not going to happen again. Okay? If you're that person. Okay? All right, guys, I will see you on Tuesday. Keep up the good work in the meantime, okay?
Thank you, Professor.
Okay. Have a good holiday.
You too.
I thank you.
Okay, bye-bye.